Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while waxing his EV. This is Through the Pines, not his legs, Brandon. On this episode, we'll cover money mind games and behavioral finance with wealth management. So, money mind games include things like emotions and money, fear, biases, cognitive errors, panic selling. What are cognitive biases in wealth management? Confirmation bias, overconfidence bias, loss aversion. Behavioral finance strategies, including clear investment goals, have them. Diversified portfolios, use them. Automatic investment plans, Brandon's favorite. Long-term versus short-term thinking, delayed gratification. That is a good tip, and we'll give you more practical tips to become more aware of financial biases and emotions on this episode of Through the Pines. So, introducing Forbes Best in State Wealth Management Teams for Utah, Baxter, Nelson, and Associates. Also, Advisor Hub, fastest growing advisors to watch under $1 billion. And the receivers of the Ameriprise Clients Experience Award, which sounds like a really good thing. Rex.m.baxter and Brandon Smith here in the studio. Welcome to the podcast. You can find their information at planwithbaxter.com. Please visit our Facebook page, Through the Pines. Follow us on Instagram at Pines_podcast and subscribe to YouTube so you can watch our wonderful, beautiful faces at Through the Pines podcast. Rex, welcome to the program. Okay.
Thanks for having us.
Was there a delay?
Well, I thought you were going to follow that up. And I was like, but thank you. We're excited to be here.
All right. So we are going to talk about emotions and money. And I know this is a subject that you are versed in because you were raised by parents of counselors, I believe. And so if you can discuss how, and this is interesting to me, but money is a touchy subject. People will avoid talking about it. They will just push it aside. Some people love it. Some people hate it. And so talk to me about the emotions and money and things like fear, greed, anxiety, and how that all plays into decision-making when it comes to money and wealth building.
Yeah. Thanks, Brandon. I love this subject. And so this is probably one of my favorite and most interesting subjects that I like to talk about. And money mind games. It's not because I like mind games, but because I like learning about how people think about money, and I like learning about the decision making and revealing with our clients and with the people that we talk about kind of the thought processes that may be creating some of their biases. And some of their decision-making processes. And so love the topic, appreciate you bringing it up and giving us a chance to speak about money mind games. So fear, greed, and anxiety, right? Those are three significant emotions that typically when we're having those emotions, we make terrible decisions. And so it's interesting to see how those impact decision-making ability and where that head trash comes from that has us make those decisions. So let's get into it, right? Let's get into some examples and let's talk about it. Let's talk about fear, right? What's more fearful than a 2008 scenario where it's one of the greatest, recessions of modern history. You saw the stock market drop, 45-50% in 9 months time frame. And what would that look like if on, December 1st of 2007, you walked in and you told your boss, hey, I'm going to retire and I'm going to retire today. And, I ran through all my numbers. They all look fantastic. I think I'm going to get great returns over my retirement. And you go in and you pull the pin, you retire. And over the next 9 months, all of your retirement savings dips by 40%. How fearful, how stressful is that?
Oh, I'm looking for another job. Yeah.
Right. You're not working. You lost your income stream because you're retired. Right. And so you have no longer, the ability to generate that income unless you go back to work. And now all of your retirement savings, all your projections, are they out the window or are they not out the window? and what's going through your head as you're watching, that $2 million go down to $1.5 million, $1.3 million, $1.2 million, and you're just seeing that, go down and down. And oh my gosh, am I going to be able to provide for my family? Am I going to be able to maintain the lifestyle? Am I going to be able to help my kids through college? Am I going to be able to travel and see my grandkids? You're seeing all these things, and all of a sudden that fear starts playing on you, and you think, I've got to stop the bleeding. I've got to make a decision, and I've got to protect my family because I've seen, other people in my life not be able to do it, and so I'm going to sell. And they let fear make that decision for them. And maybe in October of 2008, they may have made a terrible decision, locked in those losses, sold just in time for the next 2.5, 3 years to see the market recover. And they didn't participate that. They had the ability to let fear control their emotions, make a terrible decision, and lock in those losses and not recover from it.
So Rex, stagflation is probably even worse, right? Because if it drops and then the market doesn't bump up for another 5-10 years, that's a significant period of someone's retirement. So how does someone know that that a market may recover within as short of a span as it did from 2008 to 2011?
Yeah, so stagflation being something different, right? Flat inflation, but a flat market, for 5 years, right? We've gone through periods of flat markets.
Excuse me. I meant, I sort of, stagflation is one thing, but also flattening of the market. Yeah.
Right. So a flat market typically is not truly a flat market, right? And so you have a decade, what we like to refer to as the decade of no return, right? And that's the decade from 2000 to 2010, to where essentially the market ended down 1% in 2010 on a price basis versus 2000, right? That's a decade of a flat market. And yet from 2000 to 2002, the market was down roughly 40%. From 2002 to 2007, the market was probably up significantly. And I don't remember a percentage, but it was up significantly. And then 2008 until March of 2009, it bottomed, and then it came back up. But all of that movement, all of that gyration, all of that volatility took the market nowhere over that decade. So do they know? No, nobody knows. Nobody can predict that future. And we certainly have gone through periods of flat markets. But that's also taking into financial planning and into our projections and our considerations. But the difficulty is when you get the psychological behavior of letting your emotions control your decisions. And whether that's fear, such as the example that I laid out, or whether it's greed, to where now all of a sudden they saw the market recover. They didn't take any action in 2010, 2011, 2012, 2013, 2014. They're frozen because now they have something like a post-traumatic stress disorder from that downward movement. And now all of a sudden, they see the great returns of 2021. They're like, oh my gosh, I've got to get some of this. I'm going to put all the money back in the market because I need those returns just at the top of the market in time to see a 2022 when the market drops 25%.
Yeah.
Right. And that's the roller coaster of letting emotions drive your decision making.
Okay.
And you have to dig into it deeper than that. You have to dig into it as to why are they making these decisions? Right? Where does that come from? Where does the fear come from? What happened in their life at younger ages with their family, with their parents, with their siblings, with their circle of friends that have influenced that decision? What's put these concepts and ideas into their head? Is it movies, books, radio, podcasts, right? Where does that come from? And where are they getting this information from? And is it being fed? Is it being, people essentially kind of encouraging and confirming these fears and the greed and making it feel like it's okay to do? Or what's that happening? And so delving into that with clients, I think, is really important.
Well, how early on in the process, Rex, when you're speaking to a client or someone that comes to you and says, hey, I'd like to begin investing in the market, do you ascertain that and try and go through their fears, their anxieties, and how to cut that off in the past. Because I feel like if they know this, something like that is going to happen in their 10, 15, 30 years worth of investing, if they know that in advance, then it's a little easier to handle when you say, yeah, I told you this may happen, than if you never talk to them at all.
Yeah. So at Plan with Baxter, Baxter Smith and Associates is we're slowly changing our name. So that's the first time I think on our podcast that we've mentioned that we're actually changing our name from Baxter Nelson Associates to Baxter Smith and Associates. We really like to take our clients through a 12-hour interview process on that first meeting. No, I'm just kidding. We don't like to
count me out.
Brandon's like, wow. Moving on.
I'm like 12 hours.
Yeah, we don't do that.
Okay, all right.
We don't do that. I think during the first meeting or two, we like to ask a lot of questions, and even try and play a devil's advocate to your answers a little bit to try and get you to think and help us understand how you're thinking and how you're processing information. Yeah. And so, lots of times an example of that would be trying to determine your risk tolerance, how aggressive or conservative you need to be, and comparing percentage declines to dollar declines. And I've done that before on our podcast to where people that have, $100,000 and they say, oh, I'm extremely aggressive. I can handle a 20% decline or a 10% decline. And we'll say, that's great. So if 100,000 goes down to 90,000 or 100,000 goes down to 80,000, is that okay? Yep, that's just fine. I can lose 10,000, 20,000 and it'll recover and I'll be fine. Then all of a sudden we up that to $1 million and we're like, okay, so you don't mind losing $200,000 or 3 years of your income. And they're like, no, wait. I'm not comfortable with that. I never said I was comfortable with losing $200,000. I'm like, well, you said 20%. And so we kind of go through those examples, and that helps us determine kind of where your thinking is at and how you're thinking as an example. And so we'll go through different questions around money as we go, but it really does take us a long time to really get to know our clients well, right? It may take us a year, 2 years, 3 years of working with clients to really start to understand where some of that information comes from.
Okay, well, let's do a little test right now on air. We'll use me as an example. I am self-employed, and that means, and this is recently, so the income can go up or down. Like you can have good times and bad times when you're self-employed. And since this is new to me, and I've experienced times where starting a business, the income is not where you want it to be yet, right? It's a little lower. And so I find mentally, it almost prevents me from making I almost get too tight. Like I don't want to spend any money. And can that also be bad? Or what are the implications of just like not wanting to spend a thing? Is that bad or no?
Yeah, it can be bad, right? Because you still need to be saving for retirement. You still need to be paying yourself first. You need to make sure that you're saving money for your business slow times as well. So your emergency fund needs to be bolstered up a little bit. But once you get it to a certain stage, then bolstering it up 5 times higher than where it needs to be, where does that come from? Why do you feel that need? And is it because you're feeling that your revenues and earnings won't be there for a prolonged period of time? Is it because you saw another startup company or somebody else start their business, go through 2-year periods of lows? Where's that being driven from, that fear of being able to save and still do the financial things that we need to be doing to get you where you need to be in your life?
Yeah.
Right. And that's what we need to dig into a little bit, is where's that coming from and why you're doing that? Because that's the only real way to dig into how to change that thought process and how to get you comfortable being uncomfortable sometimes.
And okay. I think a hard part on that is a lot of it is subconscious, right? You don't realize, and that's the hard part of these biases, is you don't understand that there is more greed in there that should be, right? And then you don't understand that there's more fear in there. Like you think that's just the pure emote that's what needs to happen. And so getting back to, Rex's first example, right, of going into retirement and seeing your portfolio drop in half, that shouldn't ever happen, right? Your portfolio should be built such that it's not fully exposed to the market as you go into retirement if you can't handle those swings. But what would drive someone to do that? Well, I see it all the time, right? I see it. People, they look at the market, they look at the last 5 years, like, holy cow, if I can keep doing this for another couple of years, my portfolio is going to be awesome. That's the greed, right? And they think that it's analytical. They think that they've run the numbers on it. But what they fail to understand is that you can't predict the future, right? And that we need to be more disciplined about how we are investing those monies. And then all of a sudden it cycles. And ironically, the opposite of greed seems to be the fear, right? And being overly, cautious that way. But it plays into just the opposite. And so I think high level, we need to make sure that and that's one of the benefits of working with an advisor, is it helps you talk through what your decisions are, why we're making those decisions, and then helps us make an actual strategic plan to get through that.
Brandon, I don't know, are you prepared to answer these questions on definitions? Like, what is confirmation bias?
Yeah.
Okay.
So confirmation bias is simply, if I think I know something, right? I'm like, I've got a sneaky suspicion that the earth is flat, right? We'll just say, and I go on the internet and I type, is the earth flat? Right? I guarantee you I can come up with article after article after article confirming that yes, indeed, the earth is flat. I knew it. I knew it. I looked at the sun, right? It looked flat, right? I knew the whole, and yet, is it really, I mean, maybe someone would argue, but no, right? Like it's a globe, right? And so, but if you are just simply trying to find answers that you want to know, maybe not the easy answers, then you're going to find that, right? Is the stock market going to crash, right? Guarantee you'll be able to find an article and a reason why it's going to crash through all market cycles.
Not only that, but there's people on social media and YouTube who basically make that their career. Is they'll pick a niche that will confirm people's confirmation bias, and they just go all in on that. And then that's like how they make money. They get all the views.
Right. And that's what it's unfortunately mostly driven by. It's either clicks, but a lot of times it's subscriptions, right? You subscribe to this and you'll know I predicted 8 of the last, 8 recessions. And if you subscribe to me, I'll tell you when the next one is, right? Or oftentimes they're selling a product, they're selling gold, they're selling, something that's going to be able to survive the next apocalypse or whatever it is. And so, you've got to definitely be conscious of that.
Rex, what about overconfidence bias? Is that something you see?
So absolutely. I think going back to the example that I gave, right? Let's back that up just a little bit to what may have driven that decision for that person to be that aggressive going into, 2008. And it probably is overconfidence, because if you back that up 20 years and you say, okay, this person started investing maybe in the late 80s after the 87 crash, and they experienced the greatest bull market that the U.S. had ever had, right? Leading up through the 90s, up to the tech bubble. And even though we had that downturn from 2000 to 2002, it climbed all the way back up to 2007. So their experience is a phenomenal stock market, amazing returns, a setback, great recovery, all the way back up to new highs. And so they're very comfortable being extremely aggressive and have based their assumptions off of that bias, off of that, aggressive mentality.
Yeah, that's their life. That's their lived experience, is a common word we like to use these. That's their lived experience, right. And they're all in on that right now.
But
that's their experience. Yeah. And so they're very comfortable being that aggressive. And then they go into retirement and all of a sudden they got hit upside the head with a 2x4. and now because they now have based all of these life decisions off of that aggressive, bias that they've had. And now they're fearful and they just made a terrible decision because of that. And so a lot of times what we need to do is temper either the aggressiveness or conservatism, depending upon where that's coming from, right? You'd work with people that started investing in the 70s and went through uber high inflation and the best bond market in history as bonds went from a 14% interest rate down to virtually zero over the next 25 years. And so they're very comfortable with fixed income and looking at those rates of return. And then all of a sudden we're at a zero interest rate for a long period of time. Those people that grew up in that time period are probably extremely conservative and don't trust the stock market. because they saw the stock market essentially be underwater for the vast majority of their saving adulthood.
Mm-hmm.
And so in that position, we need to be able to take the opposite side of that and work with them to get comfortable with market volatility and comfortable with balanced portfolios and comfortable with trying to, keep pace with inflation over time, where bonds couldn't do that for the last 15 years.
Yep. Brandon?
And so,
go ahead.
Finish.
Yeah,
no, go ahead, Brandon. I was just going to say that as advisors, we need to make sure that we're digging into the behavioral finance and into these money mind games and the head trash that people kind of are involved in order to give them the best advice for them.
Mm-hmm.
But not only the best advice, but help them work through being able to accept that best advice for them.
Interesting.
Yeah, I couldn't agree more. And I think the lifetime overconfidence absolutely comes in, but a lot of times we see it on the short term too. I can't tell you how often, not necessarily anymore, but a couple of years ago, I'd have clients coming, oh yeah, my son or my brother-in-law or my uncle or my friend is a cryptocurrency genius, right? It's beyond me, but man, they really understand cryptocurrencies and they can trade and they're making all sorts of money. And was it really making money? Well, nobody's saying that anymore. Why? Because cryptocurrencies have fallen off so much.
Well, you got a reprieve from that in the last couple of years, haven't you?
but I think it illustrates that overconfidence, right? Was it really you picking the right currencies, or did you just get lucky, right? We saw it in the tech bubble, right? Where you just buy anything with the .com and it flew through the roof. And was that because you were really fundamentally understanding the companies and what was going to go up, or did you get lucky? And understanding it's all right to get lucky, but it's more important that we understand where that luck's coming from. Because if you don't recognize that there was maybe some luck in that, and you have that overconfidence bias, then you're going to double down on it, and maybe you still just got a 50-50 shot of winning.
Yeah. So loss aversion is fascinating to me, Rex, because loss aversion is fearing losses more than appreciating gains. And it's like, oh, I just made $1,000. Yay. And then as soon as you lose $100, like just lost $100, and then you lose your mind and forget that you even made $1,000. So how do you talk people off that cliff?
Yeah, this is one of the strongest mind games out there, in my opinion, is loss aversion, because it's absolutely a real thing that people feel a lot more pain. There's even a lot of psychological studies as far as where they've done brain scans, and they've looked at the neural centers and looked at how that kind of sparks when looking at a loss versus a gain. And so it's so true that the pain of a loss is so significantly more intense than the joy of a gain. And being able to kind of take a step back and be logical about that and taking the emotion out of it is significant. But very few people can do that. And especially when it's on their own money, which I think is a significant, value add to using an advisor. Is because an advisor isn't going to be overly emotional about your money. Not to say they don't care about your money. They care and they want to help you reach your goals, and they really do have your best interest at heart. But they're not going to feel that neural center pain or the aversion to loss that you're going to feel about your own dollars. And so that guiding hand, that steady hand, can be significant in helping you reach your goals.
And I've seen that in other advisors, not Rex, but literally other advisors who I watch them manage all these other people's money, and then with their own stuff, like they've, come, I don't know, Brandon, what, and they're just like, just in so much. And I'm like, I know you can do this in your sleep. But when it's it just triggers different. And I like to think that I'm, more, analytic, whatever. But I love running stuff by Rex. Like, all right, Rex, here's what I'm thinking. Tell me where I'm crazy, and some of that's, strategic, kind of making sure I'm seeing everything. But some of it is, just getting that confirmation, feeling good about the risks that I'm taking and where.
Yeah. So Rex, what are some that that's a strategy right there, sharing it with somebody else. What are some of the strategies you use with your clients, Rex, to overcome some of these biases when it comes to their financial investments?
I think storytelling is extremely powerful, right? And I think sharing examples and kind of pointing things out, it is always interesting to me, because I'll share a story, and the first thing, and this is so natural for everybody, is everybody's like, oh, that's not me, that's him, right? That's or that's her, or that's so and so, right? That's not me. I don't do that.
Yeah.
But that is a great story, Rex. Thank you for sharing. Right? And so it is interesting, because then you have to play, kind of that, and it's not narcissism, right? But it's that same concept of I would never do that, and everybody else would, and so. But I think storytelling is significant. I think, especially if you can make it personal to them, and walk through, maybe softly, and this can be offensive sometimes, but you walk them through kind of their own decision-making history a little bit, and kind of show them that, hey, we all have this, and here's how I've seen a little bit of this in you. Do you recognize that? And that can kind of be telling. And once they get over the hurt or anger of kind of pointing that out, then typically, we can move forward. So
Rex, how much of your job is playing psychologist and really trying to understand and doing the best for your clients? But I mean, I'm thinking of the word, you got to trick them into it, but in the long run, it's better for, you know what I mean? Like you're only out there trying to do the best for them.
Can I take this?
Yeah, so, we don't trick anybody into anything.
No.
But I do, just like I have a disclaimer that I don't provide tax advice, right? I don't provide marriage counseling either.
Yeah.
So, and yet there is a lot of psychology as far as those discussions. And behavioral finance and talking through behaviors in this industry and in this business. If you're a financial advisor that's running a good, solid, holistic financial planning practice, if you're working with somebody that's just trying to push product, or just trying to sell something, then you're probably not going to get that same attention to detail to behaviors and the same hand holding and steady hand and guidance that you might get from other advisors. So I do think that is something that if you recognize that in yourself, that you need that, and I will say that I think a lot of people need it, then you want to make sure that you match that with a financial advisor that's right for you.
Interesting. Brandon?
So all right, I'll argue with you on that, Rex. We're not marriage counselors. That's true. However, I can't tell you how often clients have said, I think we relieve significant marital stress, and not just because we're amazing or something, but because when both spouses are on the same page financially, it makes all the difference in the world. I mean, finances are one of the number one sources of stress in a marriage. And oftentimes that stress comes because people just don't know where they're at.
Well, it's the same reason I don't want to teach my kid to ski. And so you bring in a third party to do the hard work,
to do the dirty work, to be the one saying, "Hey, you're not actually doing the pizza." Right. Yes, I am. You need someone else to say, and there's a lot of truth to that.
Yeah.
And then also checking the cognitive biases, because we all have them, but oftentimes they're different. Mm-hmm. And one spouse wants to spend a lot of money, one spouse wants to save all the money, and maybe they're both wrong, right? Maybe it's somewhere in the middle. And as long as we can make sure that the plan that we make gets them both on the right track, I mean, that makes all the difference in the world. And time after time after time, I've heard, clients kind of mention that, right? That almost jokingly about their financial fights, but then they defer it. Like, well, Brandon said this, so you go talk to Brandon. Brandon says it's okay, and
you're the fall guy.
And not that right. But ultimately, I don't know that anyone needs to be a hero or fall guy, but rather just, hey, let's make sure this is within budget. And because usually the spouse that wants to save is just worried about the future. And as long as the future is in check, and the spouse that wants to spend just wants to have fun and enjoy life and get those things. And if we can make both of those happen, then they can both fully enjoy life as it should be. So
have you had couples where they just will not get on the same page?
Oh, absolutely.
Oh.
Yeah. And we're not miracle workers. Just kidding.
Yeah,
No, but
some couples that manage their finances completely independent of each other because of that exact reason, right? That they can't get on the same page, and so we've got to kind of work through that a little bit. Frequently you'll hear me say the only way I know how to work with people is we throw the issues on the table, we talk about it, we make sure that we're never going to walk away offended. You're never going to offend me. Hopefully, I never offend you. But that's the only way I know how to deal with it. And so here we go. And here's the baggage. Here's the mind game baggage that's going on the table. And it looks like, Mrs. Klein, it looks like you're going through these decisions, and maybe it's because of your family was, check to check all through growing up, and mom made your clothes and everything else. And so you feel like you need to spend today because they passed away at a young age. And so you don't see the need to save for a long time. And Mr. Client, you see that, your situation is very different. Your mom and dad are, living until they're 90 or 100, and they ran out of funds. And so now they're living at sister's house or whatever. And so you need to save for retirement. Right. And so, somewhere in there, we need to kind of marry what, both situations, so we're living for today and for tomorrow, and try and figure out what that compromise looks like, and having those conversations. And lots of times we'll have the conversation of, look, when you go away from here, we're not trying to cause fights, right? The only way that we know how to work with a couple is to communicate, be transparent, be open, listen, understand that we're all trying to get to the same place, and we all are looking out for each other's best interest, right? Nobody's trying to cut anybody off from anything. We're just trying to figure out the best way to get this, situation and goal achieved together. And having that conversation. But I think throwing conversations like that on the table and having it out in the open and hitting that on the front end, I truly believe it helps the conversations after they leave our office to be a little more open and a little more loving and a little more, trying to reach that common goal. And then when we come back for another meeting, or as we continue to meet over the years, we continue to make progress in the right direction. And I think that repetition of meeting regularly and hearing some consistency about understanding what their fears are, understanding what the greed is, understanding what those different issues are, those different mind games that they're playing with themselves, and trying to kind of navigate those turbulent waters is really good over time. But I think consistency of messaging is critical in that.
And I think that's what a good financial plan does, right? Like it helps us relieve these bad emotions, the emotions of too much stress, too much fear, or too much greed, right? It checks us when we're saying, no, I want to take more risk. It helps check and bring that in to a marriage, to a financial plan, and just bringing all these things to the table. And it's the combination of all these poor biases that makes for such fireworks and dramatics. Whereas if we can relieve them from both sides, right? So one side, it might be a relief of fear. One side, it might be a relief of overly, being too greedy that's causing the discontent. But if a good plan keeps us on track so that we can hopefully, and it's a work in progress,
Yeah. Rex, talk to me about delayed gratification. So in my notes here, I have, short-term versus or long-term versus short-term thinking, and the concept of delayed gratification and the benefits of long-term thinking in wealth management. But is that something that can be learned, or is that something that, like practice, like somebody can practice over and learn how to do that? Or is that just flat out a maturity thing and someone has to be mature enough to understand the concept before they put it into practice?
I know an awful lot of mature people that cannot put that into practice. And so I think it's absolutely a learned trait and a trainable trait over time. But I think it's a constant battle and a high wall that you have to climb, and because you're always facing it. And I think it's challenging because as time has gone on, and I think each generation, the immediate gratification becomes more and more intense of trying to do it, trying to want what your parents had, trying to have what your neighbor had, trying to buy the best, e-bike or e-vehicle or whatever, right? Whatever the newest, hottest thing in town is. And so I think that's, sailboat, right? It's tough. The fight is real. The challenge is real. I think it is absolutely trainable. I think it's interesting that, lots of times we'll talk about costs of a financial advisor, and I can get X amount of money managed for X percent at this discount firm or that discount firm, and yet I think the reality of it is that people that work with advisors typically have a much higher rate of goal achievement, of hitting their goals and being able to retire confidently and things along those lines, because of working with somebody that understands their psyche, understands their psychological makeup, and can help them balance that gratification between buying something immediately versus delaying that for being able to meet their needs in retirement, whether that be medical needs, their desire to see their grandkids and travel a little bit more with their grandkids or children, helping out a charity, helping out a nonprofit or an organization or a cause they're passionate about, and trying. But there's still there is a balance. There is something to be said for still enjoying life today.
Yeah.
And sometimes you get a spouse that's all about delayed gratification, which the other spouse thinks never gratification, right? They think that that's so far off in the future that they're never going to be gratified.
Yeah.
And yet you see the other spouse that's like, oh my gosh, you're enjoying life so much today that we're never going to be able to take care of things in the future, and balancing that out is tricky. So.
Interesting. So Rex, talk to me about, because you brought it up just a second ago, the importance.
Sure. Throw something in my lap.
Yeah. The importance of having clear goals. Like, how does that clear investment goals? So you sit down with a client and you come up with these clear investment goals. How does that ease the stress, the anxiety of finance within that, that family or that situation?
Well, I think a lot of clients have a difficult time initially of articulating their goals. Right. And I think a big part of what we do is try and help them define what it is that they're really trying to do and what's important to them. And I think that takes a lot of questions, a lot of digging in and trying to see what it is they're trying to do, and what's important to them, what their values are, and what's important. I think as we discover that, as we discover what those goals are, then I think it's much easier to say, okay, well, this is the way that we achieve them, and try and map that out. Because at the end of the day, there's only so many variables that you can control, right? You can control how aggressive or conservative you are, which over time should help greatly influence your rate of return on your money. You can control how much you save or how much you spend. You can control the goal date. Do I retire when I'm 55? Do I retire when I'm 65? Right? So there's only so many variables that you can control. And trying to marry those variables is what makes a great financial plan, and a planning process of working with those clients and saying, well, look, if we work a year longer, then this is what that looks like. If we work a year, shorter, and we save X amount more, or we take a little more risk, then we have this percentage, this chance of reaching that goal. This is our probability of success based upon, historical volatility and returns, and using different scenarios. And I think going through those helps them understand the decision making, and helps them prioritize what really is important to them. Is it more important to retire early? Is it more important to live a better life and retire later? Is it more important to deal with a little more stress and try and shoot for a little better return? Is it more important to live a little less stressful? And so working through that and showing them is critical, I think, to them buying into the process to try and reach their goals.
Well, behaviorally, and I just thought of this is not in my notes, but I'll hit you with this, Rex. Based off of trending politicians' careers and the ages that they tend to keep working into, Have you noticed that retirement's age and they just keeps going? I mean, these people are working forever, like have you noticed in your own work that, mentally it's just more people are just wanting to work longer?
Well, I think, so I think it
depends on your profession, obviously.
Yeah. And I think you have to dig into it. Why are they working longer? Is it out of necessity? Is it out of passion and enjoyment? Is it out of some narcissistic, feeling that they need to feel needed and important? Where's it coming from, right? I think as we look at retirement means something different to everybody, but to us it means the ability to choose what you do and when you do it and who you do it for.
So that's more like financial freedom, right? To reach that level of choice. Okay.
It is. And because at that point you can be done working if you choose to, but if you want to keep working, that's great, right? If that keeps you mentally active and engaged and you're fulfilling some deeper need and deeper purpose, fantastic, right? But at least you've got the flexibility to do that. But I do see a trend of working longer. I do think it's interesting, right? Back in, I can't remember, but I think, Brandon, you can probably correct me. I think the first Social Security payment was made in 1939, I want to say, to Ida Mae. And it was like 20.
Well, that was her name, Ida Mae?
Yeah, that was her name, Ida Mae.
Yeah. I've seen the newspaper article.
It was like $24 or $29 or something like that, right, Brandon?
I don't remember the dates. I just remember seeing the newspaper article, though.
Yeah, so I think it was 1939. So the average life expectancy back then was 60 years of age.
Oh, you're kidding.
Right? No. And that's less than 100 years ago. Whoa. Right? That's less than 100 years ago.
Yeah, I'm like creeping up on death pretty quick here. So
it's knocking on your door.
Oh, yeah.
Right? We could sing a song. So I think it's interesting that today, our average lifespan is 84 or something like that, mid 80s. And yet, today they haven't changed the age of taking Social Security very much, right? They've changed it from 65 to 67, and yet the average lifespan's gone from 60 to 84.
Right.
And so, people are needing to work longer and save longer because they don't have the pension, very few of them anymore. Social Security, hasn't adjusted to kick in later. And so it's less significant in a person's lifestyle than what it was back in the 40s and 50s and 60s, and yet savings rates still haven't caught up to everything else. And so that's why you see a lot of people working longer.
Yeah.
Politicians, that might be a different story.
Yeah.
Right? And so I'm not going to.
They have important business to be doing, Rex. Very important business to be doing.
That's what they tell me in their 12th term. So I don't know. But
well, we have to believe them. Brandon, talk to me about, so this is a behavioral finance strategy that is something you have mentioned multiple times on this podcast, if you go back and listen, but it is one that is probably one that the most amount of people could take advantage of, and that is making it automatic, right? Because that way, the stress is gone. You just say it's I don't even have to see it. It just goes to where it's supposed to go. Yeah. And then I can log in and look at my accounts and then blah, blah, blah. So, and I'm left with, here's what I have for spending. Here's what I have for investments. And so how do you help people get to that point, and why does it provide such a benefit behaviorally to people's mindset with their finances?
Yeah. It removes the pain. And that's ultimately when we talk about behavioral finance, it's emotional pain that may or may not be justified. And my 401k, right? I've got it set. It saves out of each paycheck. Literally don't even think about it. Mm-hmm. But I guarantee you, if I had to write a check, not that I write checks, but if I had to, pay a bill.
I wrote 2 checks the other day. It was like the first time in 10 years. I don't know what the deal was, but I wrote 2 in one day. Anyway.
Yeah. No, but if I had to Venmo my right. 401k, the dollar amount that I'm saving, I guarantee you I would think twice on it. I guarantee you, I'd be like, whoa, this month I could really use that, like, should I? And I would go through emotional pain just to get to the same spot. But if you make it automatic, if you set up those 401k contributions so they're set, you set up your insurances so that those are set and to take care of you. You set up, all these other things just to get you on track to be where you're supposed to be. Then you don't have to go through the emotional pain, right? You build your 401k and you get it allocated so that it's going to be good. And we can't predict the future. And we know we can't predict future markets, but we can set it up so that we know it has a high probability of being able to hit all the distributions we need no matter what market cycle we're in. And if you set those things up, then you're able to just not think about it, right? Spend time thinking about the grandkids, thinking about, your kids, thinking about, whatever it is that you want to spend time on, and spend less time worrying about money. It helps you make better decisions and it helps you live a better quality of life.
Yeah. All right. We're going to talk about how your financial advisor can help you mentally and emotionally with money. But first, Brandon, do you have some more numbers?
Yeah. Are we talking about Rex's morning yoga? That we're doing that with clients.
We're going to do that. We're going to actually perform.
Oh, we're doing that. Okay, we're doing that on the show. Yeah, but I do have.
We want more followers, not fewer followers.
We do have some more numbers. So while Rex gets limbered up, I can. We'll jump into this. So manufacturing, and this kind of I thought was interesting. First Trust came out and they showed, just highlighted some numbers, and this was on manufacturing jobs. And so this probably doesn't surprise you. But from the 1940s until now, percentage of the population in manufacturing has gone down.
Yeah, I saw this the other day, oddly enough.
Oh, really?
Lot, right?
Yeah. So from 1940s, and this is non-farm payrolls, right? So people in non-farm industries constituted nearly 39% of all jobs in the country.
When was this?
1940s.
Okay.
Now, just a little over 8% are doing manufacturing.
Whoa, that's crazy.
Yeah, so down fairly significantly.
So is that because the robots have taken over?
Yes.
Yes.
So one thing, and this gets into what people might not know, but we're actually the second largest manufacturing country in the world. We produce.
Second to who?
China.
Okay.
China's still, and they've got us beat. We met up in about 2010. We were neck and neck, and they've taken off since then. Okay. No surprise to anyone. But we're still number 2. And we're actually a ways ahead of number 3, which is Japan. But with all that, so even though our manufacturing jobs have gone down from 39% to about 8%, we are, where are we at?
Rex, is this good or bad?
I think it's interesting.
That's a cop-out answer, yeah.
Yeah, so we we've increased our manufacturing output by 6 times over that same 6-fold.
So the output has increased 6 times, but the amount of people
percentage of our population. Now our population has increased as well, right?
Got you. Okay.
But you multiply that by increased population and obviously machinery and stuff. I mean, we're actually producing far more. We're manufacturing far more than we did in the 50s, 60s, 70s, 80s, 90s.
Wow.
And we kind of peaked around between 2000 and 2010 is when we peaked, and we've kind of leveled off since then. Yeah, kind of interesting to see. And your question to Rex is perfect, right? Is that good or bad? Neither, right? Like, and I think anytime I did a paper in college on this, the true enemy is volatility to people, right? It really, okay, quick tangent. So I did it on the price of corn. And it turns out we actually signed NAFTA, right? North American Free Trade Agreement. And what that did was it allowed us to sell corn to Mexico. Turns out we can produce corn, or we could produce corn at a more cost-effective rate than Mexico could produce their own corn because of machinery and things like that. So NAFTA gets put into effect, and all of a sudden what happens to the price of corn in Mexico? Drops down. Is that good news or is that bad news? Well, it's great news for everyone who primarily lives, on a very heavy corn diet, but it's really bad news for all the farmers, right? So riots in the street, protests, this is NAFTA, this is a terrible thing, right? You've just destroyed all these jobs. Well, fast forward a little bit, all of a sudden we discover how to make corn into fuel, right? We make ethanol, right? Which has its evils. We won't talk about that, as far as small engines and things like that. But we start turning corn into fuel. What happens to the price of corn? Boom, jumps up, right? Yeah. Because the demand for corn goes up. And what do we have? Is everyone happy that corn prices went back up? No, now we got protests and riots in the streets, right? Of course.
So the lesson here is no one's ever happy.
Well, the lesson is that volatility and change is never easy, even if it's good. Even if it's for the betterment, the long term, right? Nobody wishes that we're all farmers still, right? Like, I'm glad I don't have to go farm and work, a farming job. But it's just an evolving.
Speak for yourself.
That being said, we love farmers and we couldn't live without them.
No, absolutely. Amen. I've got family that farms and they love it, but I guarantee you they're glad they're not farming like we did in the 40s.
Oh, sure.
Right? Absolutely. Like, nobody wants to go back to that. And but with that said, I mean, as these changes were made, I guarantee you there were farmers saying, I'd rather stick with the horse than plow, right? The stupid tractor needs oil changes and it breaks down and I'm just going to stick, And so anytime you have change, it's going to cause some growing pains.
I think this was one of your best numbers. Yes, more numbers.
Oh, thank you.
It created controversy. So bring it. Rex, what is the role? It's your role. It's what you do on the daily. It's your role as a behavioral coach, essentially, helping clients make rational decisions. What are the tips that you share with clients to make the best decisions with their finances?
I think the tips are like what we've said all along. Make it automatic, right? I think that's a fantastic tip. I think trusting, assuming that you've done your due diligence and things like that, trusting your advisor to help hold your hand and steady you through to your goals. I think trying to not make your decisions during extremely emotional times and trying to take a step back to make more logical decisions and looking at opposite points of view, right? And so Brandon and I constantly will talk about, the bear case of the market or the bull case of the market, and so has this point of view and so has that point of view, and they're diametrically opposed, right? And yet they're not lacking confidence, either one of them.
Right.
And
just watch any morning finance show.
Right.
Yeah.
Right. Any one of them, right? They'll have the same thing. They'll have a bull case, a bear case, positive case, a negative case. Right. You look
recession tomorrow, never recession. I don't believe we're going to have it. No, we're already in it. And they are so confident in their answers.
Yeah. Yeah. And the point is, everybody is typically right eventually. Right. And so, but rarely are any of them right on their projected timeline. Right. And so, I think you have to take that into consideration, that nobody can predict the future. Nobody can tell you if the market's going to be up or down tomorrow. And I think, avoid those things that are avoidable, right? Prepare for the fact that uncertainty is going to happen. That, prepare for what you can and then handle things unemotionally best you can as life events happen, as life happens to you. I think those are probably my best tips and advice, other than, I guess, the most obvious one is visit planwithbaxter.com. But that's probably the most obvious tip, right?
Rex, I'm not a gambling person. I don't know much about it at all. But do you know if, outside of doing puts and shorts and stuff, but can you go to like a Vegas gambling house and just bet on whether or not the market will be up tomorrow?
I don't know about at a Vegas gambling house necessarily, but there are absolutely, there's always somebody that will take the opposite side of a bet.
Sure. Yeah. Okay. Fair enough.
Yeah.
Also, I want to mention that I'm not a big, I don't play a lot of games. I play Monopoly and I play Pit. Have you guys played Pit?
Oh, yeah.
Okay.
Oh, yeah.
Okay.
Yeah.
Okay.
Corner on the barley.
Yeah. Oh my gosh. And I had no idea it was what it was, right? Because I learned it as a kid, and you're just collecting your commodities, and then you don't want to go out with the bear, and you want to double your money with the bull. And I didn't know I was playing the stock market game, but that's essentially what you're doing. But if, I don't know how this ties into behavioral stuff but it does set, if you're not used to the market or you don't understand the market, it's a fun way to learn what actually goes on the daily on the stock market floor. So I don't know. There's that.
Yeah, I think there's a lot of games that can kind of help you with that a little bit. I mean, Pit is fun for, commodities futures trading, right? And so not necessarily the stock market, but still dealing with volatility, still dealing with some of those emotions. There's a game out there called the stock market game, to where it has you own different stocks, you decide if you're buying or selling at the price you're buying for, and then a news event happens that drives that stock price up or down.
Yeah.
And so I used to play that with Boy Scout groups and different things like that all the time, to kind of try and teach them, just kind of the basics of buying and selling, and what can happen, and how news events affect stock prices and things, just to kind of whet their appetite a little bit. So there's a lot of different games out there that go through that. I think one of the things that people need to do is be emotionally intelligent, right? Looking internally and trying to understand themselves well enough to understand what their biases are, and why they're making decisions that they're making over and over. And the more self-intelligent they can become about those processes, I think the more successful they'll be in investing, as well as just in life and relationships in general. But I think that's much easier said than done.
Yeah. Brandon, last words on the Psychology of Money, which is a book we have, Psychology of Money. So Psychology of Wealth and Building Wealth, and, the importance of recognizing and managing that is when it comes to money.
Yeah, I think being conscious of things, and then realizing that you're not invincible, right? Because all of us, myself included, I personally love reading through these and just, trying to pick out which ones I'm worse at, than others, because we all have it, and recognizing it helps me get through it without making as many mistakes. And I know I'm still not, I'm obviously not perfect at every decision, but understanding, okay, this is why I'm feeling a little bit of stress or a little bit of pain. It's a natural human emotion as we work through, these types of things, and it helps you stay on track.
Yeah. I like that. It's a natural human emotion, Rex. What is your weak point, Rex? How do you stay so focused?
Yoga.
Well,
daily yoga.
I have 7 kids. So it's out of necessity.
Necessity.
No, I think we all have our own biases, right? And so, I was raised by 2 school counselors, right? And we, as I was growing up, my dad had 3 jobs throughout the year at all times. Worked as hard as any man that I've ever known, which has caused me to kind of try and mirror that work ethic and things along those lines, is where that comes from. But I think trying to recognize those things in yourself and kind of the weaknesses or the biases you have, and I think we all constantly learn about ourselves. We all constantly kind of fight against those biases and recognize them. And I think I'm lucky in the fact that being raised by 2 extremely emotionally intelligent individuals, it's given me the ability to try and step back and look at things very logically. And that's why I'm so passionate about this topic, is because it's so interesting to me how people make their decisions, especially around money, because money makes people do crazy things.
Are you still surprised? Are you still surprised on occasion?
Oh, almost on the daily.
Okay.
Right. I mean, I'm still constantly surprised. And then as I dig into it and I look at, this is why you made that decision. I understand. Still a wrong decision probably, but I understand, and I can laugh with you. And now let's figure out how to correct it. Right. And let's figure out where we go from here. It's not right or wrong. It's just where we're at today. And so let's just move forward and figure out how we get from point A to point B, wherever that point B may be.
I like that, Rex. So you're like, listen, I'm judging you. I'm totally judging you, but not. Like, we can totally move through this. Like
I'm not really judging.
Like, we're not really like
kind of judging you, but not really. Judging
you're like, I've seen it all, so it doesn't really matter. So, very good, Rex. Thanks so much, Brandon. Thank you so much for coming on the show. Again, this has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.